All right, thanks for tuning into Profit Insights. Immediately after the RBI policy, let's try and take stock of what could it mean for risk assets and other factors impacting. So we've seen the markets drift off post status quo on the policy, and the Nifty down about 0.6, 0.7%. The banks and private banks in particular hurt a bit more, while PSU Bank Index, which was well and truly up about 3%, has also come off a little bit, but still 2.5%, so not that bad. I think that's the key crux. And the broader end of the spectrum, a bunch of insurance companies and some result reactions. Cummins is up about 8%, Trent is up another 6%, so there's strength there. And insurance companies, at least the PSU insurers, LIC, GIC, RE, etc., all doing well. And last but not the least, look at what's happened to ITC after the news bits that have come up on your screen about British BAT talking about how they want to go ahead and maybe reduce or monetize some of their stake in ITC. The stock is down 3.5%. So lots to talk about with our guest on the show today, Manishi Raychaudhuri, a veteran investor in Asian equities, joins us right now with his thoughts. Manishi, great having you. Thanks for being in the studios.
Thank you. Thank you very much. A visit to Bombay after quite a while. It's always a pleasure to be here.
Okay, yep. Thanks, and pleasure to have you. Manishi, what's your sense? I mean, the equity markets have taken a bit of a step back today because maybe they anticipated the RBI to make some move on stance, at least, if not rates.
Right.
That hasn't happened, a bit of a pullback here. Do you expect that pullback to be more pronounced as the week comes to an end tomorrow? Do you reckon that it is difficult to portray that?
I think RBI policy was no surprise, really. So none of the rates changed, and the gradual withdrawal of accommodation, that stance will also be maintained. So I think in the market nowadays, there's a degree of anticipation about some actions. And if that doesn't really come about, then the correction tends to be deep because the valuations are already at a relatively steep level. India is, possibly the most expensive market in the entire emerging market universe. So, after the market did so well across November, December, I think this present drift that we're seeing and the kind of reaction on any real or imagined disappointment, that's also not much of a surprise. Would there be a major correction anytime soon? Difficult to predict these things, but I would rather be, possibly focused more on a kind of a drift down or what's called a time correction, over the foreseeable time horizon, so that the other emerging markets, valuation and India, while not entirely converging, comes closer, relatively closer.
Got it. Would Chinese markets need to perform for that to happen, Manishi? Or do you reckon that EMs can attract flows even if China doesn't perform?
Well, China is the 800-pound gorilla in EMs. So the EM basket as a whole performing without China, that's still difficult to sort of imagine happening, because if you look at the emerging market index or MSCI Asia ex Japan, China, despite this severe underperformance over the past 3 years, it's still about, maybe 30% or so, 30 to 35% of the index. So for such a large weight, it's difficult for the headline indices to perform with such a massive market staying down or continuing to underperform. Now, the question is, what would make China recover? And that's a question that we're all grappling with, because it's clear now that the Chinese authorities' old-style stimuli, they're not really working. I mean, they announced the RRR cut coming in from early Feb. There was a small spike over there, but nothing beyond that. So it's clear that the Chinese authorities would have to think about different measures, maybe more fiscal stimuli than monetary policy, which is more directed at supporting consumption. So we're all waiting for that. We have the meetings, so-called the twin meetings coming up in March, but it's something to look forward to.
Okay, that's interesting. And we'll slip into a quick break in a couple of minutes from now. But before we do that, Manishi, the question, therefore, that comes to mind to any Indian investor would be that while Indian markets are expensive, headline, you could make an argument that for a foreign investor who is heavily invested traditionally into banks and into IT, those two indices are not. And therefore, it's a tale of two halves. So if I want to put money into India, do I have, and if I have a long-term view, do I get pockets where they are very liquid and where I would love to put in money, where the benchmark weightages are high and I get them at decent valuation? So can FI inflows into India happen even if the headline Nifty numbers stay expensive?
Right. Now, that's a very important point you make. You know, historically, we have seen these two sectors, financials and IT, they were close to 60% of the Indian market put together, and they used to corner bulk of the FII flows, you know, particularly FII flows, not so much the DI flows. But now we're actually seeing, if you look at the consensus earnings growth forecast, they're much stronger in consumer discretionaries, they're much stronger in industrials, in power equipment, and so on. So I think there are alternative avenues of investments for both domestic institutions and foreign institutions opening up gradually. And that's an encouraging sign.
Okay, my final question before we take that break, because in your previous avatar, you spoke to FIs of all sizes, all types, etc.
Absolutely.
Is India becoming a favored destination independently, or do you reckon it will still continue to remain an EM, a part of EM, and therefore dependent largely on what happens to EMs?
Right. Now, that's a very interesting point. And after continuous and extensive interaction with foreign institutions, and I still continue to do that, I think India is gradually moving into that status where the Indian market on a standalone basis is looked upon as the likely candidate for providing supernormal returns, not just for the next 2 years or 5 years, but possibly for the next decade or two. So in a sense, if I hark back to the early 2000s, when China was first inducted into the WTO, and the next decade and a half was possibly the golden period for Chinese equities and other financial assets, in a sense, India might actually be entering that kind of a phase. There are quite a few things falling in place for India, and that's being appreciated by the FIIs, not just in terms of economic growth, not just in terms of flows, not just in terms of, say, inclusion in the emerging market bond indices, which opens up additional avenues for flows, but also look at it, a geopolitical sweet spot, which no one can ignore today.
Okay. So that's interesting too. And okay, let's do this. Let's digress a little bit and talk about some of the most recent developments before we take that break. One of them is what's happened to Paytm. And I first want to get in my colleague Vishwanath Nair, who is at the Reserve Bank of India. He's heard the press conference. He was a part of that, asked questions to the governor, and has heard with keen interest what the response on Paytm was. Vishy, fill us in on what you thought was the statement and the implication of that statement with regards to Paytm.
Right, Niraj, this press conference turned out to be slightly more fiery than what was expected earlier. Of course, a lot of focus on Paytm. The RBI governor as well as deputy governors have been very clear that they do not want to say anything about specific entities, especially Paytm. However, the broad guidance that the RBI governor and the deputy governors have been giving is that any entity that is found in breach of the norms which RBI has laid down will need to face the consequences of that breach, of that violation. No entity has any kind of free pass to act as they want. They have to entirely listen to what the RBI is saying in this matter and how exactly the RBI has drafted these norms. What the RBI is also saying is that the customer protection is a very, very key part of this entire discussion, and that is how the RBI will ensure that companies do remain within that band of regulatory limits and ensure that their operations do not affect the customers at the end of it all. Because remember that is the biggest fear in this entire saga, that after the 29th of February, what exactly happens to Paytm customers. So the RBI has been very clear that we are there to protect you and we are there to ensure that the system is protected. However, any entity that is found in breach of the norms that the RBI set will face the consequences of their action. The RBI will come out with a list of FAQs for such supervisory action so that people's doubts can be addressed adequately. So that we'll watch out for next week. However, very clear dialogue on entities which may be very big brands, but does not matter. As long as they do not follow the norms, they will face action.
Rishi, just quick 30 seconds, and we have Manishi Raychaudhuri here also, and we'll take his opinion. But just quick 30 seconds. In some sense, if the street, rightly or wrongly, was hoping for assurance of quote-unquote leniency, did that come about, or was the exact opposite heard from the Reserve Bank?
Interesting that you bring it up, because leniency is not something that the RBI wants to be associated with, especially in situations like this. Because if you remember, in the past, wherever banks have been in violation, or any financial services entity has been in violation, the RBI has been very clear that this is the law of the land. You've breached it, and therefore we are going to introduce business restrictions, penalties onto you, and you have to ensure that compliance is achieved at all costs. Now, remember that with respect to this specific case in Paytm, it's been about 2 odd years worth of regulatory action that's been going on. So the RBI is very clear that we have given you enough time, and if you have not achieved what was required on the compliance front, then that's really your fault, and you have not done what is required. So as long as compliance is managed and the RBI is convinced that the company has learnt its lesson, that's when those restrictions come off. Till that point in time, there's really no debate. At this stage, there is bilateral communication that is happening between RBI and Paytm. That's all that the governor and deputy governors have pointed out. No further granular details on what exactly is the nature of those conversations or how that is going to pan out in the future. But it's very clear that they do not want to be lenient as long as there are non-compliances. Once those non-compliances are addressed, that's when the RBI will come in with some kind of remedial measures.
Fair call, Vishy. Thanks. So, and in some sense, Manishi, is the regulator saying that we will, we are being transparent and fair, unfair to say that we are biased against fintech space at large. Does this set an example? Does this kind of damage the fintech space or nothing like that? Is it an isolated incident?
Right. I don't think at all that this should be construed as a reason to damage the fintech space. This is a specific case. The RBI has made it clear that their focus is on consumer protection and financial stability. There are certain clear guidelines that all the companies would have to adhere to. And if they're not being adhered to, after significant conversation, bilateral conversation, such action have followed. So it is a specific instance against a particular company. The RBI has made it clear. I would certainly not think that this has a broader implication for the fintech space as a whole.
So startup founders, viewers may have written to the powers to be and all of that, but the RBI, going by what they have done even in the past with some of the other systemically important institutions as well, if they have, in RBI's eyes, have gone off from what needs to be done. So Paytm locked on a 10% lower circuit. Markets slightly off as well, but there are individual moves which are doing well. Manishi Raychaudhuri, reasonably bullish on India right now, save for the valuations, believes that China and EMs need to take a bit of an uptick for the favor to return. We take a break, come back and try and talk about some specifics as well. Stay tuned. Okay, thanks for staying tuned to Profit Insights. We're talking to Manishi Raychaudhuri, and I think amidst all this talk of power, PSUs being expensive, two pockets which are continuing to do well: PSU banks and power. Now, let's talk about one particular name, which is Power Grid, which is up quite significantly in the session today, up about 5% on the back of strong Q3. The other ones are some of these power ancillaries. Inox Wind, for example, is up on the back of an order win from CESC, which itself is a power company and has done really well. Mika is here to talk about a few of these details. Mika.
Yes, so first I'll go to Power Grid, which did, run up to an intraday high of 7.5% on back of their Q3 results, which were much better than expected. Revenue growth of 2.56% driven by the transmission segment. EBITDA was also up 3.23% and net profit was up 10%. What worked for the company is mainly their finance costs fell 18% year on year and the debt equity ratio improved at 1.37 versus 1.57. We also have a City Note which has maintained a buy on Power Grid at a raised target price of 300 rupees, and they say that the improved DISCOM payment situation and the longer term need for creating more capacity creates opportunity for the firm. And the company has also approved a dividend of 4.5 rupees per equity share. But because of the 55% run up in the past 6 months, the dividend yield is now at 3.4% versus 6% 6 months ago. Then we have Inox Wind, which has signed an agreement for India's single largest wind order, and it's an agreement with CESC, and it's going to install and supply 1,500 megawatts of wind capacity over the next 3 to 4 years. They've also extended their 2 and 3 megawatt product offerings and have entered an agreement with Wind2 Energy to launch a 4x megawatt series, which does give them an edge in the space. For Inox Wind, it is up 6.6% in intraday, and the stock has also run up 148.94% in the past 6 months.
Mika, thanks. And thanks for putting that into perspective. Manishi, before we thank you, power as a space.
Of course.
Generators, ancillaries, what have you. Are you constructive?
Possibly the best economy proxy, especially when the economy is growing not as a consequence of boost to consumption, but as a consequence of boost to infrastructure and industrials, is the power sector. What do you need for industrials to, think of an economy, C plus I plus G plus X minus M, consumption, industrials, government spending, and so on. So for industrials, for investments to grow, there is almost no other direct beneficiary than the power sector, and particularly in the present day and age, where for the past several years, there had not been incremental investment in the power sector. It's quite natural that investors would be enthused at a point when incremental investments are just beginning to flow in. Right. So there, and the best part of it is that you have an entire chain of power generators, power distributors, the equipment suppliers to the sector. And if you move back even further upstream, you have, the likes of coal or other, fossil and non-fossil fuel sources. So it is actually quite obvious that this entire chain would perform in an environment where investments had not been made for the past several years.
Got it. Okay. So constructive on power is Manishi Raychaudhuri as well, but pick and choose carefully is the point. But Manishi Raychaudhuri, we'll have to wrap it up here. But thank you so much for joining in today on Profit Insights and giving us your thoughts.
My pleasure entirely.
The pleasure was ours, and viewers, thanks for tuning in. Stay tuned to NDTV Profit. Hello and welcome to the Mutual Fund Show. I'm Niraj Shah. Over the next 30 minutes or 25 minutes, we'll talk all about mutual funds. But before we start talking about mutual funds, it's important to put something into perspective. And that is what's happened to ITC. While we get in experts to talk about the best mutual fund strategies to deploy, here's the news on ITC. British American Tobacco is looking to monetize some of its stake in ITC. Let's go across to Sajid Mangat for more on this. Sajid.
That's right, Niraj. The BAT or British American Tobacco is looking to monetize some of the stake that it holds in Indian FMCG and cigarette maker ITC. Basically, as part of the earnings statement, BAT has released that it plans to monetize some of this stake, which in ITC over a period of next few years, and is working with the regulators to ensure that it gets the due permission for that. To put in context, it's planning to offload roughly around 4% in the ITC. It holds nearly 29% stake there. It's one of the early investors of ITC from early 1900s, and over a period of time, it has gone up to 29%. And now it wants to, bring in little capital efficiency, because the value of the stake is now valued at roughly around $18 billion or 1.5 lakh crores, and it plans to use that as part of its cash management or capital management, where it has told its shareholders that it plans to generate over $43 billion before dividends over the next 5 years. Niraj.
Okay. Sajid, this comes at an interesting time when ITC for the longest time hadn't done anything and now has had a significant up move. So the timing is clearly interesting that they're taking advantage of the fact that ITC is no longer the laggard that it used to be.
That's true. Also, the fact that there's a demerger in process for the ITC hotels, which comes in, and BAT would be getting a stake there in as part of the shareholding in ITC hotels as well. So, and ITC hotels is not going to be a core business for BAT. So, when that demerger happens, it seems that BAT will look to monetize that stake as well.
Okay, Sajid, thanks so much for putting that into perspective. On today's edition of the Mutual Fund Show, we are joined by Kalpen Parekh, MD and CEO of DSP Mutual Fund, and Vineet Samre, Head of Equities at DSP Mutual Fund, to talk about a very interesting note. It's an annual note 2024, which they have titled A Winning Team. And amongst things that we will talk with them on the show is what they are talking about as insights from the Tour de France for a thoughtful portfolio approach. I saw the report and I was like, we have to do this conversation. Lend itself to a little bit of mutual fund investing as well, because we're talking on the Mutual Fund Show. Kalpen and Vineet, thank you so much for joining us today. Kalpen, let me start with you. What was the genesis of writing a note like this with such a comparison of insights from a major sporting event?
Thanks, Niraj, for firstly inviting, and more importantly for deep diving on a very detailed document that Vineet and team have come up with. So since the last 3 years, we've been coming up with an annual document, which mainly is about our reflections from the year which went by and our observations on, broadly data points, trends which are playing out in the world of investing. So this annual note is actually meant for us to, improve our learning, our reflections, and transparently share with our investors and marketplace what we are thinking about. And this is also a point in time where many turning points are there. Many beliefs are getting questioned and challenged in terms of, a certain part of the market becoming frothy, some part of the market remaining, reasonably safe in terms of margin of safety. So this note allows us to put across our points of view. Also at DSP, as a 27-year-old asset management company, it is over time leveraging a lot of data technology along with fundamental experience of our teams. So the whole concept of a winning team was to see that how can we try to marry both together and, take certain investment decisions or get inputs on a daily basis, which can help sharpen our decision making and improve. And we've given a lot of examples in the note. So I think that was the backdrop, and glad that you invited us to talk about it.
Pleasure is ours. Vineet, you want to add to this? Vineet, you want to add to this?
So again, thanks for inviting us today on the show. Yeah. So see, I think why we actually picked up this theme. More importantly, also beyond what Kalpen mentioned, is the fact that we wanted to highlight two important messages out here. One, just like in case of these sporting events, there is a team effort which actually leads to success. Here we want to drive the fact that the whole DSP team as such, including our core investment team, I think the divergence of knowledge what these team actually gets in, the divergence of skill set what these team gets in, allows us to think maybe in a more variable manner, think more differently, and that is what is maybe defines how the long-term success has to happen. So that is one aspect why we have aligned. The other aspect also is the fact that just like in case of this sporting event, there is a team effort. Here also what we are saying at this juncture, when the valuations have reach where they are, some part of the markets are a little expensive, it's also good to look at diversified asset class to maybe bring your portfolio more into a aligned manner given the current valuation, and also to see that long-term success will be a factor of how your asset allocation strategy today is defined, rather than just taking a call on a specific segment which may be doing well today. So that's the overall thought process.
Now, Kalpen kindly mentioned that I have already done a deep dive. I've obviously not done as deep a dive as you would have liked, but I'll still try and pick up the 3 or 4 key aspects that at least we thought were relevant to talk about today. And we're trying to correlate them to how can a mutual fund investor per se, take insights from in her or his investment journey. So let me try and understand from you guys. You've spoken about how 2023 was a year of mid caps and small caps, and either of you can take this answer, but could it happen again, looking at insights from a sporting event and looking at what's happened in 2023, that an encore could happen, or should a person be careful about that space now that that space has done so well? Either of you.
So let me start before Vineet adds, and I want to give a disclaimer that if you had asked this question to me 6 months back or 1 year back, I would have said that the space looks a bit expensive, so broad base or diversify and be more in large caps or be more in flexi cap funds. So in a way I have been wrong, and yet you're asking me this question, so I'm grateful that you are. But we genuinely believe that the starting point is never market cap. The starting point always is that what type of businesses are available, where are they in their earnings and business cycle, and what is the price that we are trying to pay for it. And then if the outcome of that ends up giving us large cap stocks, so be it. If the outcome ends up giving us small or mid cap stocks, so be it. At large, 2 things have happened. The small and mid cap segment has also seen a lot of significant improvement in operating metrics. So ROEs look good, profitability has improved. All of that has turned very sharply positive in the last 2-3 years. That has coincided with a lot of money also coming in that bucket. So end of the day, there are 250, 300 stocks which are available for Indian investors via mutual funds or directly to participate in, and more flows in the last couple of quarters going into that bucket is also creating some bit of premium in terms of their valuations. And around the same time, if companies report marginally positive operating metrics, it's only adding to the tailwinds. So I really don't know. I've been wrong last year in terms of predicting that small caps may not do as well or mid caps may not do as well. So I don't want to hazard a guess again. But I personally, this is what I do in my own portfolio. My preference always is in diversified funds. And typically at market extremes, you get into smaller mid caps when there are sharp corrections, or use SIP as a consistent method of investing. Most of our investors have been significant beneficiaries by doing SIPs in our small cap and mid cap funds. And typically when there are phases of poor returns in the last 3-4 years, if you come in at that points in time, your odds of getting better return outcomes are in your favor. That's my view, personal view. But Vineet, if you want to add anything.
Yeah, just one data point. So, we've covered one analysis, a short analysis in this note, wherein we've captured the 7-year rolling return for the mid-cap index and the small-cap index. And if one looks at that data point, one sees that in the maybe the last 10-15 years for which we have done that analysis. On a 7-year rolling basis, we'll see that the index has provided upwards of 12% return 75% of the times, and 0% returns, the probability is 0. I mean, the history has been 0. So the point which we wanted to make here is, while it at various points we'll have extremes created in different categories, the way to deal, one of the ways to deal, because it is going to be very difficult predicting how things are going to turn out, one of the ways to deal is that not to get out of the asset category, but to expand the time horizon. So once you have, let's say, 4 categories which are getting expensive, but these are good categories to own, good ROEs, the companies are inflecting, growth metrics are there. Only point is that at extreme valuations, higher valuations, one needs to have a longer time period for as far as the investment decision is concerned, and not maybe lose track of your asset allocation is broadly what we wanted to highlight.
You know, viewers, it's a very interesting statistic that Vineet Samre is pointing towards, and I just wanted to lay out that point that they've made in that note, that for a much maligned broader end of the spectrum, and everybody likes to say that, oh, mid caps, small caps, having run so much, etc., because you are investing into mutual funds from a long-term perspective. That statistic that Vineet Samre spoke about, that they've highlighted, on a 7-year rolling basis since September 12th, the mid-cap index has returned over 12% returns 76% of the times on a rolling basis, has delivered negative returns 0% of the times on a rolling basis. Even for the small cap space, by the way, on a 7-year rolling basis, delivered negative returns only 1.2% of the times. It's a telling statistic. If you're investing for the long term, maybe, just maybe, these statistics will help you make some thoughts. Vineet, just can I ask you a quick perspective? Because you guys made this famous decision of not taking investments into your small cap fund at a point of time when you thought it to be overheated. A brave move then as well. Would you say that if you're investing from a slightly longer term perspective on the back of this statistic and on the back of the nature of the market currently, because so many sectors are formed only in the mid cap and the small cap end of the market, it might not be a bad idea to keep your SIPs going?
Yeah, definitely. So, that's the thought process that, and more so when, we do this analysis for SIP, this works out to be even better, that investing at a high point also yields to decent returns over a long period of time. And hence, from that perspective, I would say that if one really has a good 6-7 years perspective, despite the high valuations, it's okay to be part of this category. The other matrix is that, when we look at our own portfolios, there are still maybe roughly about 40-45% of our investments are still into companies where the valuations are not expensive. The valuations are below 15 multiple even today. Maybe some of them are facing a low business cycle. Some of them are not in the positive momentum or narrative today. But the point is that one needs to create a portfolio which is designed to yield success over the long period of time and have a mix of companies which can potentially deliver good returns when the cycle returns. So I think from that perspective, it's not that everything is sort of over at the moment with these high valuations. There still are opportunities, and definitely one stretches the time horizon to maybe 5-7 years. We don't see a material negativism as far as that decision is concerned.
Okay. Well, gentlemen, stay on. We need to slip into a short break. On the other side of this conversation, we try and talk about one more aspect that they've said. It's been 2 more aspects. One is the PSU outperformance, which is probably more than just a narrative, or is it? Let's ask Vineet and Kalpen about this on the other side of this quick break. Stay tuned. All right, back with the Mutual Fund Show in conversation with Mr. Kalpen Parekh and Mr. Vineet Samre, and we are talking about that annual note, learnings from the Tour de France, and trying to understand those or juxtapose those learnings with a thoughtful portfolio approach. Some of the things we've discussed. One important thing that we did want to talk about is this whole excitement around PSUs. Now, Kalpen, I don't want to spill the beans. You guys have mentioned that is the header is that is this whole PSU quote unquote excitement more than just a narrative? Can you talk about this?
Sure. So, like the title, Niraj, what we are trying to highlight here is that investing has to be a rational attempt, and if data changes and if numbers change, we have to evolve and adapt our opinions and views. So, over the last few years, even at DSP in our portfolios, PSUs which had fairly low weights over the last 2 to 3 years, when they started screening in on 2 counts. One, on account of significant operating efficiencies in their businesses. Second, on account of certain regulatory changes or certain other environmental changes, which gave confidence or conviction on the durability of their business cycle or revenues. We started increasing our weights significantly, so much so that in some of our funds the weights are in excess of 20% in the PSU bucket. Now, an important dimension was that they were also cheap. So typically how do you make money in stocks is, you get significant earnings growth and momentum. And secondly, there is valuation expansion. Now, PSUs were cheap for long periods of time over the last 8-9 years. So if you had entered in the second year or the third year or the fourth year, they were always cheap. But some of the triggers which came out in the last 2-3 years in many pockets, whether it was in the defense segment, whether it is the cleanup on the PSU banking side, or in the energy space, or even on the power side, there were a lot of regulatory changes which also came in, and that coincided with significant improvement and enhancement in business performance. So as money managers, we constantly look for data, and if that data is questioning or making us evolve our beliefs, it's not easy many times when you're anchored in a certain space that we invest only in a certain pattern. The reason to highlight this dimension, so this was also a dilemma that the team keeps on having, that is this for real, is this narrative? And there are always 2 schools of thoughts, 2 sides of a coin. But looking at how data points were evolving, operating metrics were changing, the behavior of these companies in terms of a very high quality